All right, let's get right into it. Today, we're going deep on some timeless wisdom from Warren Buffett, and we're talking about what inflation really does to your investments. Because it's not just about prices going up at the store, it's about a hidden tax that's silently eating away at your wealth.
So, you've probably heard it a million times, right? The best way to protect yourself from inflation is to own stocks. I mean, you own a piece of a real business with real assets. What could go wrong? Well, as it turns out, Buffett issued a pretty stark warning way back in the 70s that this idea, it's dangerously simple. And this quote right here, this is the heart of his entire argument. See, he doesn't see inflation as some gentle economic thing that lifts all boats. No, he sees it for what it is, an aggressive and incredibly effective tax that just consumes your capital. And the worst part? You never even see the bill. Okay, so here's our game plan for unpacking this. First, we're going to uncover that invisible tax. Then, we'll get into something he calls the equity coupon constraint. It's key to why stocks aren't the perfect shield you think they are. After that, we'll learn how to classify businesses into the great, the good, and the gruesome. We'll even meet the dreaded corporate tapeworm. And finally, we're going to do the investor's brutal math. All right, first things first, let's really get a handle on how this so-called invisible tax actually works. To make it super clear, Buffett uses this absolutely brilliant analogy. Okay, so check this out. Imagine a widow has her life savings in an account that earns 5% interest. In the first scenario, there's no inflation, but the government decides to tax her interest at 100%. Ouch, she makes nothing. Now look at scenario B. This time, there's a 5% inflation rate, but zero income tax. You know what? She is in the exact same position. The 5% inflation completely wiped out the purchasing power of her 5% interest. It's economically identical to a 100% tax. Okay, fine, that's a savings account. But we're talking about stocks, right? Businesses should be different. And this is where Buffett makes his first really big and kind of counterintuitive point about the stock market as a whole. The entire argument really hinges on this one number, 12%. Why? Because as Buffett observed over decades, this is the surprisingly consistent long-term average return on equity for American businesses. It's kind of stuck there. And here's where it gets really fascinating. Because that 12% return is so sticky, it doesn't just jump to 18% when inflation gets hot. It means the fundamental earning power of corporate America doesn't automatically adjust for inflation. It starts to act a lot more like a fixed-rate investment. He actually has a name for this, the equity coupon. And this idea, it reframes everything. If the whole stock market is basically one giant bond with a fixed 12% coupon, well, what happens to a bond when inflation and interest rates go up? Its value goes down. Suddenly, stocks look a whole lot more vulnerable. So if a market as a whole kind of struggles in this environment, does that mean all hope is lost? Not at all. In fact, Buffett gives us this incredibly powerful framework for sorting out the winners from the losers. He basically puts every business into one of three buckets. You've got the great, the good, and the gruesome. And the real difference, the thing that separates them, is how much new cash they have to keep pouring back into the business just to keep running in place when prices are going up everywhere. So what makes a business great? Well, it really comes down to two things. First, they can raise their prices pretty easily without losing all their customers. And second, and this is so important, they can sell a lot more stuff without having to build a ton of new factories or buy a bunch of expensive new machines. Think about a company with a powerful brand. That value is intangible, right? That economic goodwill is the gift that keeps on giving, especially when inflation is running hot. All right, now it's time for Buffett's most powerful, most visceral metaphor. It perfectly explains why those capital-hungry, gruesome businesses get absolutely destroyed by rising prices. It's just an unforgettable image, isn't it? This parasite that's living inside a company, just secretly sucking away its life force. So here's the critical point about this tapeworm. It has to be fed, and it always eats first. See, just to sell the exact same number of widgets next year as you did this year, the company needs way more cash tied up in inventory just because everything costs more. That cash gets consumed by the tapeworm before a single penny can be used for actual growth or paid out to you, the owner. It eats first. So, let's pull all these threads together now. What does this toxic combination of a fixed equity coupon and this corporate tapeworm actually mean for you, the investor, at the end of the day? Okay, let's just do the brutal math. So your typical company earns that 12% on its equity. Let's say it pays out about half of that as dividends, so that leaves 6% of its capital that it can reinvest to grow the business. But wait, if inflation is running at 7%, the company actually needed 7% more capital just to tread water, just to maintain its current size. So it actually went backward. The real physical business shrank by 1%. But oh no, the pain for you as an investor, it doesn't stop there. Because the government doesn't care about your real inflation-adjusted return. Nope, it taxes you on your nominal dollar gains, those phantom profits that were only created by inflation in the first place. And there it is. That's the punchline. After the business itself has gone backward in real terms, and then after you pay taxes on gains that weren't even real, your actual real-world increase in purchasing power can easily be zero, or even worse, negative.
And this is the great swindle of inflation. You look at your account statement, it's going up, you get dividend checks in the mail, you feel richer. But when you factor in the invisible inflation tax and then the very visible income tax, you may have gained absolutely nothing at all. You've got more dollars, sure, but you can't actually buy any more with them.
And really, it all just comes back to this one central theme. Inflation isn't some passive thing that just happens. It's an active, destructive force that attacks the very foundation of wealth itself, your capital. So the real takeaway from all of Buffett's wisdom here isn't that you should run away from stocks. It's that you have to be so much smarter about which stocks you own. The question you have to ask yourself is this: is my money invested in a business that's constantly fighting a capital-hungry tapeworm just to survive? Or is it in one of those truly great businesses that can actually thrive, generate cash, and genuinely grow my purchasing power over time?